Hey everyone, welcome to another financial statements lesson. In the last financial statements lesson, Sarah walked you through some of the basics like what the financial statements are, the key terms, and how everyday transactions end up in there. Now that you've got the lay of the land, we're going to take it one step further. In this video, we're looking at how to actually read those financials, what to pay attention to, what the numbers are trying to tell you, and how to start spotting patterns, red flags, or signs of healthy growth. We'll go through each of the statements and break down some of the most common indicators of performance, and I'll also show you how to connect the dots between them to see the full picture. And then at the very end, we're going to walk through a set of financial statements together. So before we get into actually analyzing these financial statements and taking a look at some of the trends and indicators, I want to kind of talk about two main strategies. You can do a horizontal analysis, so think of this as side to side. You're looking at financial statements or certain metrics, and you're seeing how they change over time, whether it's month over month, quarter over quarter, or year over year. You can tell a lot about a company based off of where the company is headed. So, for example, if revenue in 2023 was $500,000 and revenue in 2024 is $600,000, then that's an increase of 20%, which is awesome. But if you were to have just given the 2024 number of $600,000, although that's great, you don't really have a baseline to see if it is a good thing or if it's not a great thing. If the revenue in 2023 was $1 million, then $600,000 profit in 2024 actually wouldn't be that great. So looking at data in this way really gives you an understanding how the business is performing over time. The second way to analyze these financial statements is vertical analysis. So think of this like top to bottom. You're looking at one period and you're comparing one line item to the other. So for example, if revenue is $100,000 and rent is $10,000, then you know that rent is 10% of revenue. And you can do this for other overhead expenses or cost of goods sold. And then you can take that number and maybe compare it to industry average. So it really gives you a sense of the proportion of the expense or whatever you're comparing. And it's really good to measure this company's performance against other competitors in the same industry. So just to kind of see how we would actually do this in our day-to-day bookkeeping, I'm going to go into QuickBooks and let's take a look at the profit and loss. Now for a horizontal analysis, I'm going to go down here to profit and loss comparison. So by default, it's comparing to the previous year, but if I want, I can do previous period, and you can see that it's now comparing June 2025 to May 2025. And it looks like there's some revenue missing. It looks like there's some advertising and promotion and some interest that maybe should be in there. You can also do the dollar change and the percent change. So now you can see the dollar amount that it's changed month over month and the percent change. So this report is really good if you're comparing just two periods beside each other. But if you want to compare, let's say, every month over the entire year to see the trend, what I like to do is go back to standard reports, click on profit and loss, and then let's say I want to look at this calendar year to last month, so the first 6 months of the year. I'm going to display columns by months and then click Run Report. And now you can see every month over the year. So it looks like this company started in April, which is why there's no data in January, February, and March. But this is a really good way to kind of see what kind of trends are happening over a time period. Now, if you want to do a vertical analysis, you can do that here also by just doing your own math and figuring out some ratios or figuring out what percentage these overhead costs are of your total income. Or you can go back to reports and go down to profit and loss as a percentage of total income. And QuickBooks will already do the math for you. So this date range right now is March 1st to July 24th, but you could filter on just a single month or an entire year. And you can see the percentage of total income. So it looks like there's a profit margin of just over 51%. Overhead expenses are 39% of income, and you can see the breakdown here. And cost of goods sold is only 8.5%. So from here, you can kind of see if any of them look a little funky, if any of them are looking a little high or a little bit low, it might signify that there's something going on in the company. But now let's dive into actual indicators and actual metrics when you're looking at these statements. So the profit and loss shows how much revenue the business has earned, how much it costs to operate it and generate that revenue, and whether the business is actually profitable or not. So a really important indicator to look at is revenue growth. So seeing if month over month or year over year, is the business growing its revenue? Is revenue decreasing? Is it stable? The next thing is gross profit margin. So this will tell you how efficiently the business delivers its products or services. We've got net profit margin, so it shows the overall profitability after all expenses. You definitely want to make sure your profit over the year and even month over month are positive. Another indicator is operating expenses as a percentage of revenue. So a high or an increasing overhead expense could suggest that there's something going on as far as the management of this overhead expense, and it helps assess whether the business is truly scalable. Ideally, you want your operating expenses to be as stable as possible so that when you do achieve that revenue growth, you're not eating away at your profit. There's a lot of indicators that you can look at with the income statement, but the last one on this list is a high concentration in one revenue stream. So if most income comes from one product or client, it could be a risk, and diversification for long-term sustainability is always a great option. So just some more overarching trends to look out for on the income statement is consistent growth. So is revenue and profit consistent, or is it volatile? Are there big fluctuations? Is it hard to forecast? And are expenses increasing at the same rate that sales are increasing? Next, let's look at the balance sheet. So the balance sheet is a snapshot of the business's financial position at a point in time. So you're seeing what it owns, what it owes, and the overall value of the company. So the first indicator is the current ratio, which is comparing the current assets to the current liabilities. You want a ratio above 1, and what this means is there are more assets than debt. So there's more cash than what's owing, or there's more receivables than payables. If this ratio is below 1, it could be a sign that the company will not be able to satisfy all of its debts. The next indicator is the debt to equity ratio. So this is comparing total debt and liabilities to how much equity is in the company. Obviously, the higher the debt, the higher the risk. So you want this metric to be as low as possible. The next indicator is accounts receivable turnover. So you're measuring how quickly the company is actually collecting from its customers. So you want this to be as quick as possible. You want to be turning over your accounts receivable as much as possible. The next indicator is inventory turnover. So not every client has inventory, but this metric shows how efficient inventory is moving. So if you have a client that buys a ton of inventory and then it's not really moving or cycling through, it could be a sign that there's some sales issues with the product or they purchased way too much inventory. And then the last indicator we've got here is retained earnings growth. So this is good to look at year over year to see, is the company's value is obviously a lot more complex, but as far as the value sitting in the company, is that steadily increasing? And that tells you, is the company profitable year over year? And then some overarching trends to look out for is the liquidity of the company. So the current ratio increasing or decreasing? Is the debt increasing without having any assets increasing? And is AR or inventory also increasing, which could signify not collecting on customer invoices and not selling product. Okay, next, let's look at cash flow. So the cash flow statement tracks how cash actually enters and exits the business. So it tells you whether the company is surviving off of the profit, so off of its operations, or whether it's just surviving because of investments or debt. So some indicators to look at are positive cash flow from operations. So as far as the sustainability of the company, you want the company to be able to survive off of the cash it's bringing in just from operations, not from debt and not from investments. Another indicator is high capital expenditures, or CapEx. this could either mean the company is investing in its future. Maybe it's purchasing equipment or vehicles or technology, which is great, and they're investing in their own company to make it more efficient and more profitable. Or it could also mean that the company is buying assets unnecessarily. So this one's kind of a tricky thing to look out for. And then the last indicator is relying on financing to survive. So this kind of is in line with that first indicator, but repeated inflows from loans or equity raises could mean the company's operations are not sustainable. So just some overarching trends to look out for. You want to make sure the operating cash flow is keeping up with net income. You want cash flow to be consistently positive. And you don't really want any fluctuating or erratic financing activities. So looking at these three statements in isolation are good, but if you really want a clear picture of what's going on in the company, you kind of have to look at all of them together. So if revenue is growing, but profit isn't, there's likely an expense problem. If profit is increasing, yet cash is decreasing or it's tight, there might be a collections, accounts receivable, or inventory issue. You basically want to know, why is cash tied up right now if business seems like it's booming? Another thing to check out is whether debt is increasing, but assets aren't. So normally when you acquire debt, you're either getting a loan, so you're getting cash, so cash should increase on the financial statements, or you're buying it to purchase some type of asset. So there should be an asset that is increasing on the financial statements. So when debt is increasing, but assets are not, it could be a little suspicious. And they might be using that debt just to fund their operations. Another thing to look out for is whether the margins are shrinking, but sales are growing. So this could be a sign of a poor growth strategy if overheads seem to be creeping up or increasing, or if your cost of goods sold are maybe increasing at a higher rate than your revenue is increasing. And then the last thing to look out for are big swings in any account. Now, big swings in any account doesn't necessarily mean that there's something really wrong, but it normally means that something needs an explanation. So I know all of this stuff is kind of hard to wrap your head around until you're actually doing some of this analysis on a set of statements. So I want you to download the Excel file attached to this video titled Financial Statements. And then I want you to pause this video and write down a few things that you notice. Fill in some of the ratios and just write down what you see. You don't have to spend a ton of time on it, but just to kind of get your brain working in that way. And then we'll come back and we'll see if we got some of the same things. Okay, I hope you've had time to check these financial statements out and put your thinking cap on and see what kind of conclusions you can draw. There's almost infinite things you can analyze, so if I've said some things that you didn't say, or if you said some things that I didn't say, that is completely fine. So the first thing that I saw on the income statement is revenue is very stable. So this could be a very good thing. The company is stable. The second thing I noticed is cost of goods sold are fluctuating a lot, which isn't totally normal. So normally cost of goods sold is relatively in line with revenue. If a revenue increases, cost of goods sold should, and if revenue decreases, cost of goods sold should also decrease. So seeing these large fluctuations, even though revenue is staying the same, could be a sign that there's some costing issues. Maybe they're having some issues sourcing materials, but there's something going on. And you can really see that in this fluctuating gross profit margin. So we go from 40, 50, 45, 40, 60, 35, when really gross profit margin should be relatively stable if revenue isn't really changing. So the next thing I noticed, which wasn't really an indicator, but seeing financial statements in this kind of view, you can really pick out if a mistake happened. So I can see that in April, we're missing rent. So that's a really good sign for me to go back into the books and investigate and make sure rent is booked for April. So another thing that I noticed is overhead expenses are steadily decreasing. So that's a really good sign that the company is trying to manage their overhead expenses and maybe save some costs where they can. And then we can see this profit margin is fluctuating a bit just based off of the gross margin, but we're still ending with a really strong profit margin on the year of 25%. and looks like we made profit every single month. So that is awesome. Now if we go to the balance sheet, so these are just things that I noticed. I'm going to make this just a little bit bigger. So it looks like our collections are improving quite a bit. So it looks like we had 11 grand outstanding from our customers, and although it may have fluctuated a bit on the year overall, it looks like we're getting better at collecting from our customers. It looks like cash is relatively stable. I mean, you're going to have slight fluctuations just from operating, but there aren't any significant movements. There is a significant movement in April, which if I go down April, I can see that there was a bank loan of $25,000, so that makes sense. And then it looks like there was an asset purchase the following month in May. So I can only assume that the client took out this loan in order to buy this vehicle the following month. Now, if we look at AP, it looks like AP is increasing. So despite having a fairly strong and stable cash position, for some reason, the client is not paying their suppliers. So there could be something going on there that's worth investigating. And then the credit card is slightly increasing, but nothing too crazy to be worried about. Okay, and then we've got current ratio. The current ratio is well above 1 every single month, so that is great. So it looks like although the cash position and the liquidity position is still really strong, we are heading downwards, so that could be something worth investigating. And then the debt to equity ratio is also very small, which is great, which is signifying that there is more equity in the company than there is debt, which is awesome. So now if we go to cash flow, we can see that we have a positive cash flow from operations overall, but there are a few months where we go in the negative. Now, this could just be timing from, accounts receivable or accounts payable collections, but overall on the year it's positive, so that's still a good thing. The cash from investing activities, it looks like we've got this purchase of the vehicle, so that's fine. It's not like there's a ton of spending happening that's out of control. And then if we go down to financing activities, we can see this bank loan that we received. So there's nothing too crazy going on the cash flow statement. It looks like cash is steadily increasing over the year for the most part, and we do have a positive cash position at the end of the year. So that is in line with our P&L, which is good to see. Now in this summary tab, these are just a few things that I pointed out, but again, there's almost infinite conclusions or different lenses that you can look at this from. So as far as profitability of the company, it looks like gross margin is fluctuating, which raises the concern of cost management. Is it a costing issue as far as sourcing different materials? Maybe their suppliers are fluctuating their costs. We just don't really know right now. It looks like overhead expenses are decreasing throughout the year, which is a sign of effective cost management. And then the company has a positive net profit month over month, which is a great sign of a healthy company. As far as cash management, cash seems fairly stable, which is a really good thing to see. They are getting better at collecting from their customers, but they're not really paying their suppliers. And maybe this has to do with the fluctuating cost of goods sold. Maybe there's some negotiations happening or something like that with their suppliers, and maybe that's the reason why they're not paying, but it's definitely something worth looking into. And then profit and cash are both steadily increasing in unison, so this is a really good thing. So this is a sign that the company is sustaining itself through operations, which is great. As far as growth and stability, revenue is consistent every month, which is a sign of stability. If revenue was growing, it would be maybe a sign that they're looking to grow the company rather than just maintain the status quo. But if that's the client's goal, then that's the client's goal. Profit is highly impacted by the cost of goods sold volatility. So because cost of goods sold is such a high percentage of the revenue, those fluctuations are really, really impacting the whole company's bottom line. And then the company has minimal debt, so we can assume the company is, again, funded by the operations. So that's great. And then as far as risk, The debt to equity ratio is really strong and it is steadily getting better, which shows the value or the equity of the company is increasing without the debt increasing. There's minimal interest expense, there's no contingent liabilities, which is good. So overall, the company looks fairly low risk. So by kind of looking at companies from these different lenses and using these different ratios and indicators and trends, you can kind of see if things are making sense, if you can kind of grasp the story. And then if there's any missing holes, like for example, the cost of goods sold fluctuation or the accounts payable that the client isn't paying off, these are things that you can then go to the client and say, hey, I noticed cost of goods sold are really fluctuating, or hey, is there a reason why we're holding on to these supplier invoices? And then they should be able to kind of fill in the gaps as far as the story of what's going on with this company. Okay, so that is it for this one. Now you've got some tools to start reading between the lines of the financial statements, not just what the numbers are, but what they actually mean. So these patterns and indicators are what help you give real insights, whether it's for your own business or for a client. But don't worry, this does take a little bit of practice and it gets easier the more you look at real examples. And remember, you don't have to memorize anything, you just need to know what to look for and the right questions to ask.